I'm almost hesitant to say good afternoon to everybody because it's been quite a day in the markets, but good afternoon. I'm Stephen Ban from the Investment Solutions team here with Stephanie Link. I guess today's title was prescient. The title of today's webinar, we planned it around inflation, is the sky really falling? But on a day when the Dow is down almost 400 basis points, the S&P is down over 400 basis points, and the NASDAQ is down almost 500 basis points, it's a natural question to ask. And when days like this roll around the market, I always remember what it said on the first page of the Hitchhiker's Guide to the Galaxy, if you ever read that trilogy in 4 parts, which was the instruction, don't panic. But one could forgive people for panicking. So Stephanie, before we get into what's going on more broadly and talk about inflation and what's going on and what the Fed's going to do, can you just talk about what's going on today?
Yeah, no, and it's great to be here. And I have a tissue in my hand only because there's so much pollen outside, not because I'm crying because of the market. So I apologize if I have to wipe my tears. But it's good to be here. It's good to talk about things like what's happening on a day like today, because the last 3 years have been great. Stephen, you and I have talked about this. The last 3 years, you've got 28% compounded annual growth in the equity markets. You had a pretty disciplined bond market and performance there as well. They've held in, and it was pretty nice to be involved in investing, right? And so I think, fast forward to this year, I think people forgot that we can lose money in equities. Certainly, that's not a big surprise, but we could also lose money in bonds, and that's what's happening. So we're getting the 1-2 punch, we're getting the whammy. Now, I do want to set the stage because what we've talked about all year long, I know, Stephen, you want to talk about today, but it's just all related to what has been happening and what we've been talking about all year long. So far, right, year to date, we've talked about unknowns, right? The unknowns about the Fed, the unknowns about inflation, unknowns about war, unknowns about China, and unknowns about, back to the Fed, can they engineer a soft landing? And those are things we haven't talked about in a long, long time. And so those are the concerns out there. They have been the concerns. And by the way, that's what's going on today too. But we also have had some good things, and that has been a resilient consumer. So I'll get to your point about today, because that's a little bit in question. We've had a resilient consumer. It's interesting to me, Stephen, and I'm interesting to hear your thoughts too. We had a retail sales number that was printed on Tuesday that was much better than expected.
Right.
The control group, which goes into GDP, was much better than expected. The revisions were much better than expected. So everyone all of a sudden, because of Walmart and Target, and I respect it and we'll talk about it, but we have a consumer that's actually okay. We have a shifting consumer, but we have a consumer that's okay. And services within GDP last week grew 4.3%. So that's a positive, but a debatable point for sure. We have business investment that's on fire, up 9.2%, and we have earnings that are running up double digits. That doesn't seem to matter because we've had multiple contraction all year long, and it's continuing today. So we've gone from the S&P 500 at 21.6 times forward estimates at the beginning of the year to now we're under 17 times. And could we go to the historical averages of 16 times? We sure could. I bet you anything we could overshoot that, right? Or undershoot that 15 times, 14 times. It depends on what you're thinking about where interest rates are going to go. And this week, while we had some good news on retail sales, we had bad news on companies, and we had bad news on the Fed, all of a sudden, they're sounding more hawkish, and more hawkish. And so as they sound more hawkish, and they don't know, Powell admitted he doesn't know where the neutral rate is, which what we thought was about 2.5% sort of. He said they don't really know. There are some people out there, myself included, that think the neutral rate is 3.5% given where inflation is. So you have all of this uncertainty happening. And that is why people are basically just selling what they gained, some of what they gained last year, selling their winners and getting a little panicky. And in this kind of environment, as you know, Stephen, I have said for all my career in TV, you turn the TV off, you turn everything off. And
This from somebody whose part of the career is being on TV, by the way.
exactly right. And what's interesting, I can kind of get the sense from the CNBC crowd. They're also a little bit nervous because I'm now on, instead of, I wasn't supposed to be on the rest of this week. I'm now on Thursday. I'm on twice on Friday. I'm on twice on Monday. So just honestly, I'd love for you to watch me and the team, but it's a little bit panicky feeling to me. You just have to take a deep breath and just look and see what the facts are. We do in investment solutions, we do a lot of fundamental analysis. And while I'm not going to try to tell you, and I'm not whistling past the graveyard, that things aren't good, things are not as bad as what the market is telling you right now if you have a long-term commitment. And we do, and we are thinking about long-term. So Stephen, I'm going to stop. Do you want me to pivot to Walmart and Target and that sort of thing? You go wherever you want me to go.
Well, yeah, that's exactly where I wanted to go. You talked about, let's talk about where the facts are. Of course, the facts you spooled up. We've got strong retail. We've got a strong consumer. We've got earnings that were not only strong, but a lot stronger than anybody thought they would be.
For
right?
Sure.
So underlying the market is a fair amount of strength. And at the same time, Walmart got punished a few days ago. Target got punished today. What are the facts underlying those?
I want to go through what Brian Cornell said today, more so
It was a great interview.
And right, and more so even than Walmart, because I thought Walmart, he was not as convincing to me. It seemed like they were caught off guard. Well, Target totally caught off guard, but the comments were helpful, and it's very important to listen to these conference calls. So, okay, so what I'll say about Target is Brian Cornell, the CEO, said today it was a tale of two stories in the quarter. It was the front end store versus the back end store. What does that mean? Front end store means what is demand, back end store, what are costs, right? So the front end, I'm going to start with the positives, like I talked about on TV today, is the front end actually was pretty good. A comp of same store sales is 3.3%. Now, you might not get excited about that, but that's versus 23% last year. So a very tough comparison, right? But 3.3% was a strong number, better than expected. What we do in retail is we look at a 2-year stack. It's just averaging the two, that's all. The 2-year stack was up 26%. That's versus Walmart 2-year stack of 9%. So all of a sudden, you know, okay, Target's taking share. That's a good sign, right? That's okay. Traffic was up 4%. That was up relative to 17% a year ago. Now, I know I'm getting a little wonky, but I want to make sure you guys know, like, we had tough comparisons last year. So the numbers that they put up on the demand side remained strong. And by the way, Brian Cornell said in the month of May, the numbers were actually strong, like demand was strong, Mother's Day, etc. So, okay, that's the positive. That's the only positive I can tell you. The rest is all negative. The negative is the back end was disastrous. So gross margins, their costs rose substantially. So gross margins fell for over 400 basis points. Higher markdowns. Then there was a shift from discretionary products and demand to consumables, and then also freight cost and supply chain. Now, we knew about freight cost and supply chain. Everyone has said that. Walmart said it. Amazon said it. Everybody's been saying it. We all know that. The interesting thing today is the shift towards consumables versus discretionary, and that happens to impact Target more. The point of it is consumers are clearly feeling the pinch, and they're trying to go for more of the everyday stuff, food and that sort of thing, versus apparel. And that makes a lot of sense. And unfortunately, Target has more apparel stuff than they do have food. But it's not all gloom and doom. The reason why I think Target is actually down so much is because of the speed of the change that the company has seen, and they weren't able to navigate and pivot. It's a very big company. It's very hard. March 1st, they had an analyst meeting and they reiterated every single financial target, right? So then all of a sudden, 2 months later, 2.5 months later, they're lowering their profit guidance by 25%. that's a shock, right? So that's something, right? And then you had also other retailers like Home Depot and Lowe's. They were not unscathed. They had issues with ticket. They had traffic issues. And of course, Walmart started the whole thing, and they really did not have a lot of good color and commentary, in my opinion. That's why I really hone in on Target, because I want to let you know, like, we're doing this deep dives fundamental analysis, and I'm trying to figure out, okay, what did I miss? What did we miss? What's going on in the macro? And the environment, so far, all of these companies have said the change, the speed of the change, the velocity of the change from the consumer, given inflation and maybe limited government checks and just uncertainty around the economy, has led to a shift in the consumer. And of course, we all know what gasoline prices are doing. We all know what inflation is doing. We've been talking about inflation for a year and a half,
Right.
but now it's coming home to roost. And so,
can I suggest we dive in on that a little bit?
sure.
Because I think we in many ways, and Walmart and Target are seeing some evidence of this and seeing some signs of it. We have almost a perfect storm on inflation, the likes of which I don't think any of us has ever seen before, right? We have monetary policy, which has the money supply has been growing for a very long time. The Fed's balance sheet is bigger than it's ever been. We'll talk in a little bit about what them going from quantitative easing to quantitative tightening is going to do. But for right now, we've had very stimulative monetary policy. We're coming out of a period of very stimulative fiscal policy. And even though that ended, as you've said so many times, and I'm sure you'll talk more about that, it takes a while for that to work its way through the system, right? So we're still seeing some of the impact of that. We're still seeing some of the impact of reopening demand, which gets to the labor shortage and gets to higher wages. And then, let's sprinkle in an energy crisis of sorts a little bit. And here we are after years of everybody saying lower for longer. And suddenly it's like, what just happened?
It's so funny that you say that, because there's a reason why you and I have talked about this many times, and I've mentioned it. There's a reason why you don't fight the Fed on both sides, right? So when the Fed is pumping in all of this liquidity, and let's just remind everybody how much liquidity was pumped into the system between fiscal and monetary over the last 2.5 years. It's 60% of US GDP. Okay, so that to me, every time I say it, I'm always like, oh my goodness, it's such a grand number, because back in 2008, which was the last crisis that we all kind of remember, the fiscal and monetary policies that were put in place were 8%, 5 to 8%. Any way you look at it, it's 5 to 8%. So that's a really big jump, right? And you know what? We needed it. Stephen, we needed it. We closed the economy. We closed everything. We know we needed it. So we had it. They put it in place. Here's the problem. Last year, when the economy started to show a V-shaped recovery, the Fed did not pivot. They stayed very, very accommodative. And you've heard me say this many times, even as recent as March of this year, they were buying just as many bonds as they did in April of 2020 when we closed the economy down. So we have all of this stimulus that's in place, and it does filter through. To your excellent point, it does filter through, and it takes a long time to get into the system. So now the Fed is like, wait, by the way, now we have a lot of inflation across the gamut. The war did not help. China did not help. Supply chains did not help. So I don't really want to pounce on the Fed, because I will give them an A+ for all of their efforts in March and April and May of 2020, when they put everything in. They were just too slow. I'll give them a D for too slow to move on all the inflation characteristics that we have seen and that we were talking about, and we have been talking about for over a year. So they're slow, and now all of a sudden they're talking hawkish, and that's scaring people. And then all of a sudden you have high inflation that's eating into the consumer. Again, it's a lot of different moving pieces. It's like the all systems bad at this point. But let's not panic, because eventually the supply chains will get resolved. Eventually the economy will slow. It was going to slow anyway this year. We've talked about this. it was already going to slow because we weren't going to have fiscal and monetary like we had the last 2.5, 3 years. So we were going to see slow growth. Unfortunately, the inflation is probably going to slow it even more, and the Fed being hawkish is going to slow it even more. I just don't think, again, with retail sales from the government on Tuesday, and then listening to what I'm learning for so far from the Targets and the Walmarts about demand, it's a demand shift. I don't see recession this year. And the market, unfortunately, doesn't believe anything, and they're just selling every single thing. Now, and it's not just about the consumer, it's about being over-owned in certain sectors over the last several years. And I know you were going to ask me this question. I knew it. I knew you were going to go there, so I'm just going to go there. But tell me if I don't answer the question. We have had such a rally in FANG, tech, comm services, where at one point last year, it was 38% of the S&P 500 waiting. That's huge. That's huge. That's enormous. And now it's unwinding because we're going to sell what we can sell, take our money where we have some money, maybe not this year, but the last couple of years. And higher interest rates and higher inflation doesn't bode well for those two sectors, right? It's those are long duration assets, which is one of the reasons why I have been underweight tech and comm services for a very long time. Maybe it was not the best call last year because tech held in, but it's been a darn good call this year because tech has not held in. At some point though, Stephen, and we can talk sectors if you like, there's going to be opportunities. We're going to want to find some great quality sale. For the time being, with higher interest rates, higher inflation, unknowns, you want to own good free cash flow companies, good balance sheets, little debt. Dividend growth. Mike Shea is doing an amazing job in his dividend growth strategy for that very reason, because everybody wants to go and they're gravitating. Maybe a little bit more value versus growth because those are shorter term assets, duration assets. And so I'll leave it there and you tell me where you want to go.
Oh, well, that was spot on. I told you this. I was with Nick Bonsai from Strategas yesterday.
Oh, yeah.
And, I think a lot of people around the firm read Strategas. We're both big fans of them, have been for a long time.
Yes.
And two of my biggest takeaways there were, first of all, and we've been saying this, higher rates and higher inflation is bad for long duration assets. And that means long duration bonds and stocks.
Yes.
So things that are growers without earnings are getting hurt. And those same things that are growers without earnings are kind of almost a corporate currency. They're easy places to raise cash, and their valuations, because their earnings are low, look like they're kind of out of whack. So it's an easy thing to pull back from. And we're seeing some of that. And at the same time, we're seeing some what we think is probably indiscriminate selling as well.
Yes.
Which is why you look today and see, red on everything, even the VIX, by the way, which is kind of funny, but except for crude and natural gas. And while we're not here to talk our book, the idea of wages being up, but prices being up more, so real wages coming down, suggests that we may be looking for consumers looking for more things on sale, which is why TJX, which you own in your portfolio, is up. So can you talk a little bit more about value versus growth? Because this is kind of a regime shift that we've been paying attention to, but it's been pretty persistent this year, that value has been outperforming growth.
And it's the question to ask, Stephen. It's so for the last 10 years we've had growth outperform value, and maybe a little bit towards the end of last year you started to feel it a little bit, because as you know, I'm large cap core and I could be growth and value, and I am growth and value, but 75% of my index that I'm weighted to is the S&P 500, which is growth. So if I'm making a bet on value, I'm making a really big bet on growth against growth, right? Mm-hmm. And so I started that last year, and it worked fairly well. And then it's been this year, and that's what's helped. And Mike, again, large cap value, Mike's done very, very well. And dividend growth kind of has a component of value to it for sure. And his portfolio has done very, very well. Look, I think at the end of the day, we've had 10 years of growth. We have managers that have never understood value. If Twitter is any indication, today someone tweeted out to me that you should just end your value mantra and just stick to the large cap growth names. Well, how did that do for you today?
Yeah,
Not so
right.
good. How has that done for you year to date? Let me get you this number. I actually, if I can find it quickly without bothering you guys too much, but Russell 1000 growth year to date down 26.6%. Russell 1000 value down 9.5. So I hate to be down. I don't want to be down. Nobody wants to be down. But if you had more of a value strategy versus a growth strategy, you're at least treading water better than the next who were focused on growth. And
Yeah,
it goes
you're
back,
down 3 times as badly if you're in growth as you are in value.
you could do the math better than me. Thank you. So the whole point of it is it goes back to what we just talked about in terms of if inflation is going higher and interest rates are going higher, you do not want to own long duration assets. And to your point, not only in equities, but in fixed income too, right? You want to be shorter duration, which we have been. Doesn't feel good when you're down, but if you're down less, at least you're hanging in. And I do think that as long as the Fed is doing what they're doing, and they are, according to Chairman Powell yesterday, they are putting their foot on the accelerator, which right or wrong, and I will say wrong, I will say they should get to neutral and then see, but he said we'll get to neutral and then we might not see, which was a little strange. So right or wrong, as long as rates are going higher and inflation stays persistent, that's hard for long duration assets. And that's why value has done better than growth. There's going to be a time, Stephen, you and I talk about this every day in our morning meeting. There's going to be a time when, hey, guess what? The Fed may slow us down. They have a terrible track record of engineering a soft landing. And so maybe they don't get us a soft landing. Maybe we go into recession. Okay. But maybe at that point, you do want to shift more towards growth. Because if you have slower growth, you want to find growth stocks because they can grow no matter what. You don't want to own more value cyclical companies, but I don't think we're there yet. And I really think, again, what we talk about every morning in our meeting is it's been a long time since we've seen a commodity cycle, and we're in a boom at this point. And I just don't know if that's going to change on a dime, even if demand slows, because supply has been so constrained. Does that answer your question?
Yeah, very much. And it actually leads into the next thing that I'd like to talk about, which is the Fed and the tools that they have at their disposal right now. We heard Powell say they were going 50 basis points. I and others have speculated that he really may regret having said they're not considering 75.
Oh, sure.
And I wonder whether yesterday's hawkish comments were maybe softening things up so that he could say, well, maybe now we are considering 75, because you've been saying for a long time that they're behind the curve. And I think that's being shown in spades right now. But they have a couple of tools that they have at their disposal. One that they've used before, which is the Fed funds rate. And we all know how that works, and that affects the short end, which usually affects Main Street. But one that they haven't really used before. We've been in a long period of time of quantitative easing without really much quantitative tightening, really going back to the Great Recession. And theoretically, quantitative tightening, the reducing of the size of the Fed's balance sheet with some amount of speed and some amount of aggressiveness ought to take the long end out too. But can you talk a little bit about sort of where you see those going? And then we'll move that into, maybe we start to outline the reasons to be concerned, the reasons to be optimistic. And then before I ask you to answer that, I'm going to remind everybody who's on, and we appreciate you joining us, to submit questions on the Q&A tab, because we're going to leave time to have questions answered, and that's what that's there for. So, talk about the Fed. Where do you see them going? And why should we be optimistic, and why should we be hiding under our desks?
Right. Well, let me start. I usually start positively, but I'm going to start negatively because I don't want to be too consistent on that. Honestly, if you go back since 1930, the Fed, when they embarked on a tightening cycle, have only been successful 10% of the time in terms of a soft landing. That does not mean that they won't engineer it this time. I'm hopeful that they will. I'm just looking at the track record, and it's not so good.
And just for everybody listening, because I want to make sure everybody knows what we mean by soft landing. What we mean by soft landing is capping inflation without causing a recession.
Right. So there's words words that you're hearing right now, recession, you're also hearing stagflation, which is no growth, high inflation. It's very possible we have stagflation, maybe less so on recession. Again, because of what I believe is there's so much stuff in the system, stimulus in the system that'll carry us between now and the end of the year. By the way, I want to be clear. I don't think there's a recession in 2022. 2023 is a different ball game. And I think, given that the market is a forward-looking indicator, they're pricing in recession next year. Okay.
Right.
We have to see, this is like strange for me because I usually look 12 months out, try to discount it back and that sort of thing. But we are in unprecedented times. We don't know if the Fed gets to the neutral rate. The neutral rate would get the Fed funds up to 2.5%, sort of. As I mentioned earlier, I think it could be more like 3% given where we are in terms of inflation. Whatever that number is, they said they want to get to neutral and then they'll assess. Although yesterday he said he wasn't going to assess. He said they were going to keep going, whatever they're going to do. He's changing his mind as on the fly. I guess my point of it is we just don't know. And that's why the market is having multiple contraction and uneasiness because we don't know. We've not seen something like this before. And I'm pretty darn sure, Stephen, you've been in the business for 30 years, myself included, 30 years, Mike Shea, 30 years, Bob Lyons, 30 years. The four of us have seen this kind of a thing in some variation, not exactly like this, over the years. But I'm going to tell you right now, there are a lot of PMs, a lot of hedge funds, a lot of fast money, a lot of day trader memes that are actually have never seen something like this.
Right.
And so it is a little bit of a path. That's why you're seeing the uneasiness. So my point is, let's not rush to judgment because again, I think we could still probably grow about 2%. Earnings can probably grow 5, 6, 7% this year. But we'll have to see. It depends on how fast they put the brakes on. And to your QT, quantitative tightening commentary, if they were to complete what they said they were going to do, which eventually gets to drawing down 95 billion a month in QT, that gets you another 30 to 35 basis points of tightening in terms of equivalency. In terms of it's not short rates rising, it's another way of tightening the cycle and tightening monetary policy. And so it's just another way of slowing things down. Now, my preference would be stop at 2.5% in terms of the Fed funds rate and go more QT. You can steepen the curve. There's a lot of things that they can do that would maybe be a little bit calmer to the overall environment. It wouldn't be as obvious that they're trying to jack up rates, kill housing, and kill the consumer. So there's a lot that we have to wait and see. And that's why I hate it, because as investors, we want to be forward-looking investors. And so honestly, I'm trying to say, where are there extremes? We'll talk about sectors and ideas later, but where are there extremes? Is Target going out of business?
No.
Okay, is Meta going out of business? There are some companies that are absolutely doing awesome underneath the surface, but there's some challenges macro. Should they get punished this much? I got to look for opportunities, Stephen. You know that's about that you know I love to buy quality on sale. Is
Exactly.
Starbucks going out of business? No. So I have been looking for companies that have really gotten crushed and trying to upgrade the portfolio, my portfolio. I know Mike is doing the same thing. These are the times, it's like 2020, back in March of 2020, when everything was going down, it was like, oh my goodness, they're throwing everything out.
Right.
And I feel like there's an opportunity. Is Apple going out of business? No, it's just that Apple is very overowned. Back to the comment of everybody own tech, so everybody's selling what they can. So we can go into that in more detail. But the point of the pivot on the Fed is we don't know what's happening with the Fed. There's a lot of things that they are going to do. There's a lot of things that they can do. He said there's a lot of tools in the toolbox, whatever that means.
Yeah, there's two.
Right. And he just wants to slow things down because he thinks that that's the only thing that's going to help inflation. One last point. He's not going to be able to slow things down on inflation by themselves. We got to get supply chains fixed.
Correct.
Because that's the bigger piece that will help. So let's watch CPI and PPI over the next couple of months. Maybe we're at peak. I think we're going to stay high for a long time. I don't think we're going to stay at 8.5% in terms of CPI, 11% and PPI. I think maybe we get back to 4. That's still above average though. That's too much for this economy to handle. And so we have to adjust to a new paradigm in the economy. Higher inflation. I hope it leads to above trend growth, but I can see where people talk about stagflation.
Right. And 4, if we're in that 4 range, if you look historically, well, that implies PEs for the S&P in the 15, 16 range, which means, there's, to your point, we still may overshoot where we are today.
Yes.
And I guess I want to reiterate, and you've written about this at length, but I think it's really important because we're starting to get some questions, and I want to go through those while we have time. But one of the key ones is, how do we position right now? And I know what you'll say, so I'm gonna jump ahead. This market is all about quality.
Yeah.
This is classic Warren Buffett. When people are fearful, be greedy. When people are greedy, be fearful. It's classic. When stocks are on sale, you should buy them and not sell them. And the team, you and Mike and people around Hightower who pick their own equities, are looking for high quality companies with good market share, with experienced management teams, especially management teams who've managed through difficult times before, who are generating free cash flow, who have high quality balance sheet, who have the dry powder to make it through difficult times. And this is where we all try to remind everybody that while we pay very close attention to the markets on a day-to-day basis, there are very few of our clients who need this money tomorrow, right? This is a long-term game, and it's an opportunity to look at buying things that are on sale at attractive prices.
And I have been very fortunate. My father has been in the business for 60 years as a financial advisor, as a branch
What a great
manager.
guy, by the way.
And he's been around for a long time, and I adore him. The very best thing that he ever advised me, and I'm pretty sure that the advisors that are listening on the call and what you're telling your clients, is the very best thing you can do is dollar cost average, right? So even if you were to invest in investment solutions, or even if you're investing for your clients, whatever that may be, nobody can pick the bottom, nobody can pick the top. But I'll tell you, it is really easy to say, I buy low and I sell high, and nobody does it.
Yeah.
But it's very hard to do. And so that's why dollar cost averaging makes a lot of sense, because you might buy high one month, but you might buy low the next month. And over the time period, it averages out, and you actually have dividends and quality. And so to me, that's the way I view investing, because it can get a little panicky feeling at this point in time. Let the experts like ourselves, let me get more gray hair, let Mike get more gray hair, Stephen, you know, a little bit of gray hair there. Let us get more gray hair. This is what we do for a living, right? We're absolutely focused on everyday investing and the nuances. And you and advisors, some of you enjoy that too, but some that don't. Spend time talking to clients and trying to help them, and let us help where we can. But this is what we do. And so I think that's a really important strategy, and that's what we employ in investment solutions whenever we get new money in. We all dollar cost average because we feel like that's the most important thing. And it's funny though, when you do look at the long-term returns, it doesn't necessarily it doesn't mean that when you dollar cost average, you actually get better returns, or when you put it all in one lump sum. It really actually seems to kind of equal out over the years.
Exactly.
But it makes you feel better, right? It makes you feel better to try to at least average in and not to jump in with 2 feet.
Well, and I want to add to that, and thank you for that, because needless to say, we're in violent agreement on it. But markets like this are behavioral finance 101. And we have Hightower people on today, and we have clients who have entrusted their assets to us on with us today. And to the advisors and to the clients, I would suggest this is a time to try to remove emotion. For clients, this is a time to look for experienced experts who can make dispassionate decisions, because it's easy to get scared, and it's easy to look at a bunch of red on the screen and say, well, I'm going to sell everything. And buy high and sell low is not the objective. Behavioral finance 101.
Yeah. I will also say, just to actually back to your earlier comment about what we do on a regular basis. I'm very fortunate. Look, I'm on TV a lot. I'm very fortunate to be a face, part of one of the faces of the firm. Stephen is, Mike is. We're all trying to do what we can do. But I'll tell you that often CEOs reach out to me. And what's interesting about this week, I'm not going to give you names, but I have 44 names in my portfolio. Mike has about the same. I think I have less than 44. I kind of throw that 44 out there. I know Steven's like cringing. He's like, no, you don't really own 44. I probably own 38 to 40. I'll let you deal with the numbers. But anyhow, I have received emails from 5 CEOs this week alone. Hey, do you want to catch up?
Right.
I see on TV, I know you own us or you may not own us anymore. Really want your opinion, what's going on, that kind of thing. And that is a benefit, a big, big benefit of being at least visible. And also maybe just as a factor of being old in the business. And I've known these people and I've met them when I was with Jim Cramer and Nuveen and everything else. But the point of it is we have access, and it's really sort of interesting. The CEOs have conviction in what they're doing, their businesses, but they also want to hear about, well, what the heck is going on in the markets and what can we do better? And I won't mention exactly who, but it's sort of interesting, the companies that have reached out. It just is very, very telling. And that means a lot from an investing point of view for the long term, because it means that whether the CEO and the CFO, they know what's going on. They know what's going on in their businesses, but they want to know what's going on from an investment point of view. That's shareholder value creation. That's trying to be. So anyway, that I think was interesting, that I got 5 phone calls. Emails.
Absolutely agreed. And it gets back to the idea that many businesses, even with the red on the screen, even with their stock prices down, have underlying fundamentals that are very solid because of the consumer. Because of stimulus, because of smart management, because of strong balance sheets.
And because many of them a year ago saw that there were some things, there were problems. So maybe you can say Target didn't see it. I think that's too alarmist, that things have changed so quickly in the last couple of months. But there are companies that saw that the environment was changing and they put price increases in place to help offset the higher inflation that they were seeing. So it's really important to kind of just analyze, well, who's proactive and who's not. And that's also something that's very, very important. And also in the fixed income market too. Who went to the bond markets in 2020 when we had, who could get access to the debt markets, right? And just help their balance sheets and help their liquidity situation. It's really very telling.
So a couple of interesting questions, and if it's okay, I'm going to take the first one.
Sure.
Because I'm an old bond guy, and the question is a CD ladder now a better alternative to bond mutual funds? And of course, the answer to a lot of these questions is going to be it depends. And the answer to that one is it depends on what your investment horizon is. Okay, if you have a short-term investment horizon and you really need to have the bonds, a laddered approach probably makes more sense because you are going to get par at maturity. And bond funds tend to get hit in the immediate term in rising rates until they can adjust, until they can roll off their shorter maturities, buy out at longer maturities, and take advantage of those higher rates. So I guess that's what I would offer there. Is it depends on your horizon. With that said, if you have a long horizon, buying bonds that are yielding more attractively than they were 6 months ago can be very nice for you. You look like you want to add something.
No, all I would simply say is it's diversification.
Yeah.
And it's you have to, no one can time all this, right? So great. We in investment solutions, we've been long duration, but how do you know when that thing on the margin changes? And if you're longer term, wouldn't you want to have, it's just like an equity portfolio. You want to have all kinds of diversification, which is why, like, if you own a Target today, but then you also own a TJX, you don't feel as bad, right? It's just a simple little example, but same thing with the maturities, to me anyway, in fixed income.
Yeah. And sort of building on that, you would never say, well, I'm going to have everything in the world in small cap value. And yet there are people who will sometimes say, I'm going to put everything into short duration fixed income. In fact, in some markets like this, high yield can become very attractive. Volatile, but again, you can get good yields. It depends on what your it depends on what your horizon is. Couple of questions, and I love this one. Couple of questions about gold. Gold, theoretically, in an inflationary market, should be up. It's not.
Gold is, gold probably should be up. I've never made money in gold.
Right.
Never have I made money in gold. And I think a lot of it is because there's so many cross currents what's happening in the currency markets just in general, right? And there's a big inflection. And then there's also the whole Bitcoin. Is Bitcoin taking over gold? No, so not absolutely in my opinion. That's just my opinion. But I would simply say that there are so many cross currents that are happening around in terms of what currencies are doing, what the Fed is doing, and what interest rates are doing. But it's a tough asset class because you can kind of make a case. I've learned over the years to own gold all the time, but I really it's almost, talk about a store of value. It's almost like a placeholder.
Right.
Personally, especially with interest rates going up, I'd rather own cash.
Put some of this in context. Gold year to date is only down 76 basis points. 12 months, if I'm reading this right, about 3%.
Right.
So doing better than the markets. I'm with you. I've never really understood the trade. It seems sort of arbitrary to me, nor have I ever made money in it. But that leads to, there are two other questions, and you touched on it. And of course, the answer is we're not really going to speculate on it, but on Bitcoin. I'll talk a little bit about that first. The question was, is Bitcoin going to take the place of gold? And if Bitcoin were taking the place of gold, it would be up in an inflationary environment, not on a tear down right now. There are some questions about, is there a buy point in it? Is there a floor at a certain level? And I think I can say confidently, we don't have a point of view on that.
No, and I would just simply say, I think it's too early.
Yeah.
There's not enough people involved in it. And when you don't have enough volume in any currency or any asset class, the volatility is substantial. I've tried to understand what the store of value is, and I sort of kind of understand it. I don't necessarily believe Bitcoin is it, but I will say that if you wanted to invest in it, it's not trading on fundamentals. So every day you can wake up, it could be up 1,000, down 1,000, up 50,000, up down 50,000. Or down, not up, down 50,000. But the point of it is I could do all the fundamental analysis I want on Bitcoin, but it doesn't translate into how it trades. And so what I would suggest is, if you want to play that market, and it certainly is in my mind playing for the time being because it's just too early, 2, 3, 4% in your portfolio, have fun with it, but don't ever make it more than that. It's almost like I can do all of the analysis in the world on a Chinese pure play company, right? Take any of those technology companies. I'm not going to mention any of them because I don't know any of them, but I could do all the fundamental analysis I want. I mean, until the cows come home. And I can say, oh my God, it's cheap. There's catalysts. They're gaining market share. Doesn't matter. You wake up one day and the government decides to close you down, and you have no say whatsoever. So I think as a long-term investor, if you want to have a little bit in emerging markets, you want a little bit in Bitcoin, certainly have some fun with it, but just know you could lose money. You could lose 100%. You could make 100%, but you could lose 100%. And for me, I can't sleep at night as it is with the portfolio and running equities and fixed income and that sort of thing, because obviously the volatility, but at least I know if I do my homework, I know eventually I'll get paid back for it, because eventually it will be appreciated. And I'm not sure about Bitcoin, and I'm definitely not sure about Chinese pure play.
Yeah, well, and I think you and I and Mike and our team, we're kind of old-fashioned investors.
Yeah.
We believe in businesses that sell things or sell services and make profits and generate cash, and often return that cash to shareholders. And those are some of our challenges with the likes of gold and Bitcoin. And I hate to keep invoking him, but Warren Buffett had strong points of view, certainly has a strong point of view on crypto, but had strong points of view about gold as well, about the notion that you just own gold. You don't own a piece of a company. You don't own anything that generates cash flow. You own a precious metal. And it historically has been a good hedge against inflation. And I remember reading recently that over the last 10 years, it may have been one of the best performing asset classes. but it seems to have decoupled from real rates right now. And consequently, one should go in advisedly. We're just about out of time, and I want to, first of all, thank everybody for being here. Thank you for being here. Thank our attendees for the excellent questions. And there's one last question that I think is the appropriate one to close on, which is, if there is a recession coming, how should people be positioned?
Well, I think it goes back to being diversified. That sounds like a cop-out, but it's not. I still feel very, very strongly that a barbell strategy makes sense. I don't think you want to be all in on defensives, because defensive stocks, staples, REITs, utilities, they're expensive. And in fact, I tweeted out today, the staple sector is at a 25% premium to the S&P 500, and yet it fell 6% today. So you were not guaranteed on a down day of as much as we were that it would hold up more than the market. They might over time. Dividends will help. Free cash flow is going to be great. Balance sheets, quality. I'm mindful though that tech has been wrecked and really some of them are really super cheap. So I'm watching that sector. And I'm also mindful of some cyclical sectors like financials, which are so well capitalized that also have gotten hit, or industrials or energy. Energy is very well over owned at this point in time, but I think into pullbacks, we want to own that too. So I think you want to own a lot of various different kinds of companies. And I'm sorry that doesn't really give you the magical bullet that you're looking for, but it will help. And it's served me well year to date on a relative basis.
Yeah.
Certainly helps Mike as well. So diversifying is an important strategy. But free cash flow, if I can tell you to watch anything at a company, free cash flow generation is so important, because even though something like Target fell out of bed today, they still generated a lot of free cash flow, and they can reinvest and fix their businesses when you have a broken situation for the short term.
Well, we all talk about wanting to have quality time with our friends and our families, and now is quality time in the market.
That's right.
It is absolutely time to focus on quality. Stephanie Link, our chief investment strategist, a well-known and very successful portfolio, and my very dear friend. Thank you so much for joining us today. Thank you everyone for attending. Thank you for your questions. And as ever, if we can answer questions, or if you have questions that you want to ask of your Hightower advisors, now more than ever is a really good time to seek the opinion of people who've been down this road before. I hope everybody has a great day, and go spend some quality time.
Thanks, Stephen. Thanks, everyone.